Hello, Matthew Bell here with InsurancePrescription.com, and today I want to talk about the health of your life insurance policy, and in specific I want to talk about something called an in-force illustration, how it can be used, what is it, what's it good for, and other questions in that vicinity. Simply stated, an in-force illustration is a document that provides information about your life insurance policy. The information is of a particular kind, and it's for a particular purpose or purposes, because there are a number of documents that actually provide information about your insurance policy, or at least some information. So one of the obvious ones would be the actual contract. The actual contract would include a copy of the application, and both of those two things together are going to tell you certain things about your policy. For example, it'll tell you the coverage amount and any riders or anything else that was attached to it when you purchased it. There also might be a policy summary. The summary might disclose things like the current level of death benefit, the amount of your premium payments, and the mode or the frequency of the premium payments, whether you're paying it monthly or quarterly or semi-annually or annually. And even your life insurance bill or statement will tell you something about your life insurance policy. Generally, it's going to tell you the amount of premium that you owe. It may also tell you whether or not there's a loan on the policy. You might receive dividend statements if your life insurance company is a dividend-paying company and your policy is a policy that is susceptible to or eligible for dividends, and a lot of information besides. But an in-force illustration is another document in addition to those, and as its name suggests, it is a kind of illustration. So what's an illustration? An illustration is basically a set of projections, and these projections are going to concern policy performance, policy values, and things along the lines of that. Now the kinds of information, the kinds of projections are going to depend on the type of policy that's being illustrated, at least in part. For instance, a term policy illustration might simply provide coverage amount, death benefit level, premium amount, and that kind of thing. It might also provide information about the renewability of the term contracts. So if the policy may be renewed at a future time, it may also indicate what the maximum premium amount might be at that renewal anniversary. So if the term policy is renewable, then after the expiration of the initial term, the policy illustration or a policy illustration might also show you what the maximum amount might be in terms of the premium that you would pay if you opted to renew the contract. A permanent policy illustration will also include information about cash accumulation and projections for future cash growth. Universal life policy illustrations may also disclose the impact of various different funding options, generally with universal life and other sort of adjustable or flexible premium schedule policies. Whether you fund them, to what extent you fund them, and how frequently is going to impact the growth. Additionally, there are going to be certain things regarding the interest rate assumptions that are going to be necessary to know, and those also would be included in a policy illustration. So in general, an illustration is a snapshot of the health of your policy. It's also going to give you a fix on how well the policy is performing. It lets both the policy owner as well as the insurance agent know how the policy is developing and how it has performed since the time it was issued until the time that the in-force request was processed. And all the in-force part means is that it is the one that is applicable to your contract. It's an in-force contract. The contract is one that has not been terminated, and so the policy is in force, and the illustration therefore is simply a snapshot again of the health of the policy at the time the snapshot is taken, and then a projection about how it will continue to perform in the next year, 10 years, 15 years, 20 years, whatever. Again, if there's a cash value component to the policy, as there will be in the case of permanent insurance products like whole life, universal life, then the in-force illustration will show how the cash has grown, or, as occurs once in a while, how it has failed to grow, or even in some cases, how it has diminished. Additionally, the illustration will reveal the current death benefit amount. For policies that have been taken out with dividend-paying companies or participating companies, generally the policy death benefit may grow over time. That is to say that the death benefit, if the policy has been in force for several years, the death benefit, at least of a cash value permanent product, is often going to be slightly higher or even possibly considerably higher than it was when the policy was first put into place. Contracts, on the other hand, with non-dividend paying companies or non-participating companies, often their death benefit is simply going to be fixed, and I'll put an asterisk on both of those because I'm assuming that either the death benefit will stay consistent or that it will slightly increase if the policy is, again, a dividend paying policy. But it is also possible for death benefits to decrease over time. I'm going to do a separate video on that because there's any number of reasons why that might be the case. Just for present purposes, I'll sketch a few. You might have a decreasing term policy that is designed to decrease its death benefit over time. The policy may have had a market-connected component, and products like this, often universal life, are usually termed variable products, products that have some kind of a foot in the door with the market, and if market performance doesn't pan out, it can negatively impact cash values, death benefit, and all of the performance of the policy. Another reason a policy's death benefit might decline is that you either cashed out all or part of the policy, whether you may have taken a loan against it. You might also have allowed the policy to lapse, which of course would bring the death benefit all the way down to zero, which is certainly a decrease. And another thing might be that you've exercised some option or you've elected for some kind of an option that has a negative impact on the policy's growth or on the death benefit. Once again, I'm going to get into that more in detail because I think it deserves a more in-depth discussion, but for present purposes, we'll just say it is possible to have the death benefit go down, and certainly you want to know that if it's happening to your policy, and the way to know it is going to be to get the in-force illustration. Further pieces of information that are provided on an in-force illustration concern how the company thinks the policy will perform in the future. So up to now, if you're looking at how the cash value is sitting presently, what the death benefit is presently, it's also an interesting question. What do we anticipate the death benefit or the cash values, whatever is applicable to your policy, what do we anticipate those being in the future, down the road? Now, there may be several pages to these projections. They often encompass the most difficult, in some cases, the most important part of the policy's in-force illustration. The info can be a bit daunting, and that is typically because it is presented really in a dense format. It's usually tables. If you're not used to interpreting these, it might be somewhat difficult to navigate. But what you're going to see is you're going to see various values. Oftentimes, they're going to be sort of indexed by the year. In other words, if you've taken it out at your age 50, then 10 years down the road you're going to be 60, and so you might see different ages or years that the policy's been in force. You're going to see different assumptions disclosed, assumptions about current rate of interest, guaranteed rate of interest, and different assumptions are going to create different projections. And these projections are, for the most part, going to be a function of the actuarial department in whatever insurance company you are doing business with. So again, the policy's illustration may be literally year by year. It may simply hit different policy anniversary dates. The header information will often tell you what the assumptions are for that particular batch of projections. So for instance, if there's a guaranteed rate of interest being assumed, then you can think of this as kind of the worst case scenario, at least for cash value growth, provided, once again, that asterisk, that you don't tinker with the policy, that you don't take cash out of it, that you just leave it alone, then the guaranteed rate of interest projections should be an indication of the worst case scenario. However, that also assumes that you're funding the policy correctly. So in other words, if there's required premium, you have to pay out or the policy would lapse, potentially. Or if there isn't required premium, you have to understand whether or not the projection you're looking at is assuming that you're paying into it, or if it's assuming that you're not paying into it, because each of those is going to matter in terms of the future growth and health of the policy. But with a guaranteed rate of interest, you can think of that kind of like the floor. The policy is supposed to not perform worse than the guaranteed rate of interest. But other assumptions can be and often are illustrated, and these would include the non-guaranteed assumptions. So these non-guaranteed values are usually based on what are called current assumptions or current interest rates, and how these are arrived at can be a somewhat difficult and convoluted conversation, but the simplest way of understanding it is that the current assumptions, they're going to be somewhat connected to the current interest rate environment, to the current market environment. The appeal of the non-guaranteed values, of course, is that your policy is going to have the potential at least to perform better than the guaranteed amounts. But of course, there's no guarantee that the non-guaranteed assumptions are going to be the actual experience that you have with the policy. So the idea is your interest rate, your crediting rate could be greater than the guaranteed, but it wouldn't be less. That is, again, unless you tinker with the policy, unless you take cash out of it, unless you don't pay your premiums. But the in-force illustration also may show you different costs associated with the policy, and this is important to keep in mind too. So whereas the interest rate usually has a guaranteed minimum, oftentimes various costs are going to have guaranteed maximums. So these would represent a ceiling in terms of some of the expenses that you would imagine incurring with that particular policy. And of course, the expenses are going to have a negative impact on cash and other facets of the policy in some cases. There are literally an indefinite number of various projections that might be included on an in-force illustration. And once in a while, an insurer may make projections that somebody, whether you or an insurance agent, considers to be unrealistic. That may tell you something about the company or about the agent who prepared the illustration. And what I mean is, if you ask the insurer about the health of your policy and how they expect it to perform, and you see on the top of the header that they have assumed a 10% rate of return or 15% rate of return, something that just strikes you as outlandish given the current market, given the current interest rate environment, then that would tell you something about the value of those projections and possibly about the caliber or about the honesty of the agent or the insurance company that you're dealing with. But generally, they are going to be fairly tightly tied to current assumptions. They're going to be generated by actuaries who really don't have any particular stake in you buying or not buying, because actuaries, and what I mean is actuaries generally aren't going to be working on commission. They're not the ones selling you the policy. If you don't like the values that you see and you decide to terminate the policy, the actuaries are not affected directly. There are any number of reasons why an in-force illustration is going to be very helpful to you. The first is going to be a comparison situation. Obviously, this is going to be vital. If you're considering replacing your policy with another policy, you're going to want to make sure you're comparing the two in terms of projections, in terms of current values, head to head. And you're only going to be able to do that when you have an in-force illustration on your current policy. Number two, it's going to be a good practice to have an in-force illustration at hand whenever you're considering surrendering a policy, cashing it out, terminating it in any way. Before you do anything to cause the policy essentially to end, you at least should understand how the policy has been performing. Maybe you do it anyway, but at least you have the information. In addition to that, you're going to want to have an illustration before you exercise any option or elect any feature of the policy that is going to tend to have a negative impact on performance or on performance projections. So that might be changing the dividend option or changing the insurance from a regular policy to a paid-up policy. It's also a good idea to have an annual review of your insurance policies, and an in-force illustration can be an extraordinarily valuable addition or valuable tool during any kind of review process, because it is likely to provide you with more detailed information than what you would be able to find on a summary statement or on some kind of a stat card by itself. Additionally, as interest rate environments and market conditions change, you're going to want to get an updated in-force illustration, because as I said, the projections in the illustration are calibrated to whatever the current environment is. So if the environment changes, you're going to want to know how those changes are going to impact projections for your policy. And that information would be on the in-force illustration. Finally, if your contract is lost, then the in-force illustration is going to give you a more detailed snapshot of the features of the policy in some respects than some of the other materials you might have at your disposal. If a policy is lost, there's going to be an entire procedure. I'll give a video on this. Mostly the insurers are able to provide you at least with a certificate of coverage that's going to show that you do in fact have a policy with that insurer, even if you can't locate it. I should say, as just a reminder, projections are never hard and fast. They're not guaranteed. And finally, my usual disclaimer, I am not a financial advisor. I am not your insurance agent. I cannot give you any advice regarding your policy. This information here is simply for general purposes, entertainment purposes, and certainly if you need any recommendations, you need to consult with a licensed professional in your area. But if you found something of value in this video, please like it, please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me, and I look forward to seeing you again in another video.